Good morning, everyone. You're all very welcome along this morning to our webinar with DWF Law on employee ownership trusts. This is a I think a growing area of interest for many manufacturing businesses, particularly manufacturing businesses and family-owned businesses in Northern Ireland. Obviously, changes to the UK's tax regime in the last budget has made people kind of sit up and take notice and maybe look at what their succession plans are, how they manage that succession in a way that benefits the business not just now but into the long term, and how that can be done in a tax efficient way. As I say, the budget and later on today the results of the spending review will be of real interest to manufacturing businesses. So I think today's webinar is very timely. I'm very pleased to be joined this morning by James Morrison, who's the corporate partner at DWF, along with colleagues Scott Kennedy and Jon Stevens. And between them, they have both the legal and the tax expertise that will allow you to hopefully get some really good insight into this area that people are beginning to explore much more. We do have an opportunity for questions. Please do use the Q&A function or use the chat function and send those questions through to us. Obviously, we're not here, and the guys from DWF aren't here to offer free legal advice. Obviously, each business has their own issues and their own establishments. So if you do want more detailed information, then we will be sharing contact details with our speakers at the end of this. We will be recording the session, and we will be sharing the recording and also the slides after the event. As I say, I'm very pleased to welcome along James Morrison, who's the corporate partner at DWF based in Belfast, and his colleagues. And James, I'll hand over to yourself, and we'll come back at the end of the webinar with some questions in our Q&A function. Thank you.
Thank you very much, Stephen, and welcome to everyone this morning. It's very interesting to see everyone so EOT curious in this webinar today. We're delighted to see so many people there because it is something that I think if and when you decide it's best for you to take on as business succession, that you do go into it with your eyes open and understand what you need to do and undertake to avail of the tax benefits that come with disposing of your shares in the business to an EOT. And I would very quickly just summarize how we're going to do today's talk. I'm a partner in the corporate team along with my colleague Scott Kennedy. We've both got experience of acting both bank side and seller side in relation to EOTs. And my other colleague from our Birmingham office, Jon Stevens, is our global head of tax and private capital. And he has vast experience of doing EOTs throughout the UK. And I'm very delighted to have him here instead of having to listen to Rachel Reeves for this morning, though I'm sure he's got one ear on that as well with regards to the changes. So hopefully all of this will still be applicable in 45 to 60 minutes time, but we're pretty confident that the government are pushing EOT still, and the indications were from the last budget, which was that they were still of a view that this was a structure that they could get behind. And I think that's how you have to view it. It is a business structure. So when you consider what it is, it's effectively a trust, and a discretionary trust is that. It's not a form of tax relief. And whilst a tax-free sale of capital gains tax is enticing, an inappropriate or poorly planned sale into an EOT could push that company into a bad place and jeopardize its abilities to repay any amounts due to the sellers. So we would try to discuss in this talk what they are, why you should use it ahead of the other options you may have by way of succession planning. How do you do it? Because there's a lot of bespoke elements to this, which are something that an experienced advisor should be taking you through. And then, like I said, what's been changing in EOTs over the last 12 months. Because there has been developments with the budget, as with everything. So what is an EOT? It is an employee ownership trust, and I'll keep on using EOT as my acronym because I like to talk, and I don't think I'll hit the time limit if I keep on saying employee ownership trust every time. So forgive me for that. But the EOT model isn't a particularly recent one, albeit one that I think people are talking about more in Northern Ireland in the last couple of years, and there's a number of different reasons for that. It was introduced by the government in 2014. And it had the intention of encouraging more employee ownership models. And like I said, importantly for business owners, any sale of the business to an EOT is potentially tax-free, which means that owners can extract the proceeds of sale over time without facing a dry tax liability whilst consideration is unpaid. It allows owners to remain involved with the business to ease the transition for the continuing employees and management. And roughly the statistics that the employee ownership groups have been detailing over the last 3 or 4 years state that nearly 2,000 EOTs have been established in the UK to date. Northern Ireland was somewhat behind on this until some recent very notable examples. Savage and Witten, which is an EOT that we advise on, DWF, and also Relinia. And you'll also probably have all been involved or seen messaging from Employee Ownership Ireland, which is a fantastic group that's been up and running for the last few months. It got officially launched in February and is doing a fantastic job in terms of educating businesses in terms of the merits of EOTs and how they can best transition to an EOT in future. And I've had the pleasure of meeting that board, and they're doing tremendous work. So I suppose the question for you is what your key points should be considering here and why you think it's good for you. And the reason why you think it's good for you is probably a couple of factors. And if these apply to you, you probably should be thinking of succession planning generally. What's your likely timing for an exit? When do you feel that you want to leave the business? How do you want to leave the business? Do you have a situation where your family don't want to take over? Are you in a situation where a trade sale or a management buyout is probably unlikely? And do you feel that a tax-free sale is enticing? I know the answer to that last one is probably yes in the affirmative. So with these benefits, you obviously have the ability to go through the process, and the process is essentially 3 parts to it. There's the trust part to it, there's the corporate part of the acquisition, and then there's the tax part to it of availing of the tax remedies. And all those 3 parts do require advice in each section. So you do need a person who's an expert on trusts, you need a person who's an expert in corporate law, and you probably need and you certainly need a person who's an expert in tax. Now, we're pretty lucky in DWF that we have those ability to service that, but just something that you should always be careful of when you're choosing your advisors. It is a very technical process. It does require careful review to ensure compliance. One of the key things you'll need to be thinking about in the OT is how will your transaction be funded? Will it be done by way of bank debt, or will the debt payments interact with trustee payments to sellers? So essentially, the one thing that is always mentioned in the OTs is that the payment is not made 100% upfront at the start. The payment normally comes in deferred payments over a number of years, and they can vary. Your next question is how much control you wish to pass to your trust. It has to be a controlling interest, so it has to be over 50%. In the cases that we've seen on smaller businesses, it's normally been 100%, but in the very larger transactions, and an example in Cardinal Maritime, which was the highest valued EOT to date, the percentage was something in the mid-50s. So ultimately, you just need to understand yourself when you're doing your feasibility studies, how much control you wish to pass to the into the employee ownership trust. And you want to understand how long it will be before your final payments are made. A key thing to also consider is your employee group and the messaging to your employees. That should be critical because you want to obtain the benefits that come with employee engagement. And the messaging piece is something that we'd always emphasize to everyone. It shouldn't just be considered that it's business as usual. It should be given with the message that the employees are now engaged in the business because you will receive the benefits from that. They also have an indirect ownership because they own it through the trust as a beneficiary, and it's that messaging that they are not specifically the shareholder, but they're a beneficiary under the trust, which needs to be clear to them, and also what payments they're likely to receive as a result of the transition, because ultimately it is a change in business. The role of the trustee board is also critical here in terms of gaining independence for the trust, and you will have a variety of different interests on the board that's well put together to allow for the compliance. The last thing I think you should always consider on a EOT is how to incentivize key management who are not sellers, the kind of management who would have been involved in the management buyout otherwise. They are critical usually to the long-term financial success of the company. The bonuses that come tax-free to employees may not be sufficient to keep them interested, and there are, of course, mechanisms that you can put into place to keep them incentivized as you move and transition to the EOT, and we'll talk about those separately in this. So very quickly then, moving on to the process. Apologies. The EOT, it's a trust. It purchases a controlling shareholding in a trading company. And I'm going to say the word company very specifically here. One of the most common types of EOT is professional services businesses. Solicitors' practices, for example, architects' practices, they have been very commonly moved over into EOTs. And the highest percentage of businesses that have moved to EOT are actually professional services businesses, businesses where people are at the center of it. It's then very closely followed by manufacturing businesses. And just to be very clear, it has to be a company which has where you can buy the shareholding from for the tax reliefs to be obtained. So if you are set up as an LLP right now, you would need to transition over into a limited company before you actually go through the sale to the EOT. Now, that's not a particularly unusual step for a number of businesses, but something that you need to bear in mind, particularly when it comes to messaging to employees, because essentially you are transferring the employees, first of all, to a limited company, and then the limited company is then being bought by the trust. The EOT holds it on trust on behalf of the employees as a whole, the beneficiaries, and the trading company, like I said, must be a limited company. The sellers of the shares will often be paid for their shares out of future income generated by the company via deferred consideration. The period of time for these payments is negotiable and can be covered off in the legal documents, and I'll detail what the usual legal documents are later on in the presentation. And basically what you have going forward is the same trading company, now wholly owned or maybe partially owned by the trust. The trust must, however, have a controlling interest with a board of directors, which will usually include seller representatives to ensure that the business is still performing, independent trustees, which are vital to ensure the independence of the trust, and employee representatives. And they can be voted up through an employee council if necessary. Again, the legal paperwork can cover that. But that will be your mixed board on your trustee company. Now, I'm a bit of a visual learner, but I'm also a terrible graphic designer. So this diagram is the best I could do to sort of explain this in the way that hopefully it can allow everyone to understand. But essentially, this is a sample structure where you have continuing shareholders and selling shareholders. In other words, you haven't sold 100% of your company to the EOT. You've sold only a controlling interest of 55% or 60%. So you will have shareholders in the business who will continue on in conjunction with the trust under a shareholders agreement. This may not be the case for other businesses where the trust will buy out the 100% of the trading company. And like I said, what goes one way are the shares, the controlling interest. What goes the other way is the purchase monies. The one key thing to remember is for sellers is the purchase monies will not come in as one lump sum at the start. It can come through bank funding. It can come through installments from distributable profits of the company, but usually it can take between 5 to 10 years for the full payments to be made. Depending again on the structure, all of that is negotiable. For the employees who were the employees of the trading company, they remain the employees of the trading company, but they're now beneficiaries of the trustee, the beneficiaries of the trust, which is owning the trading company. So ultimately, they're entitled to the profits of the company once all future liabilities have been paid off. So they also have the benefit under the tax regime of income-free tax bonuses up to £3,600 per annum, which the company can give income tax-free. They still have to attribute national insurance to that, though. But that is effectively the structure that will look in place afterwards. It's not as complex as my diagram lends it to believe, but it does require certain key steps to be done first of all. And then very quickly going through the pros and cons of an EOT. And I think this comes back to what the advantages are for succession planning. And I think if anyone's ever listened to the people at Employee Ownership Ireland, you can only understand what they would consider to be the advantages of it, and realistically around preservation of company culture and continuity. It shouldn't be considered as a tax evasion in that respect. It should always be considered as, does your company have the kind of company culture that you believe employee ownership will benefit it? Because in theory, it does allow for employees to be more engaged, for employees to be retained. I know Stephen has spoken regularly about employee retention in this sector, and this is one of the mechanisms that can hopefully provide for that by giving them the incentivization to continue on the business. They now are effectively the beneficiaries of the business ultimately. So statistics have shown that employee-owned businesses are rated 12% more productive than their counterparts. In theory, this should be a seamless transition. There's no third party involved other than maybe intentionally a bank funder. It should remove the stress and complications of an intense diligence and questionnaire process with a third party, and just general deal uncertainty and deal fatigue with a third party. So provided it's structured right and that you have your advisors on board, you have the control over the timelines. It should also improve your corporate governance because you have workforce representation at all levels of the company decision-making process. And like I said, it should have tax benefits, both for sellers and employees. But then the question is it the best option for you? And to think about that, you need to think of what the other options might be. Other options might be a management buyout. Other options might be a trade sale. Other options might be finding private equity investment. And each of those options may be more appropriate for your business. The main risk that people find with EOTs is the valuation process and whether they believe they could have got a better return from a third-party trade buyer or private equity. Ultimately, there is a risk in the valuation that if you overvalue your business for the purposes of HMRCs, they will believe that your exemptions are no longer applicable. And this is ultimately, as I said, a self-financing option. It's coming from the company's money to pay to the sellers. And are the founders and sellers of the business prepared to accept deferred payments over time rather than an upfront lump sum payment at the start? There are obviously constraints going forward as to what the trustee company, who's now the controlling shareholder of your business, can and can't do. That's all set out in the trust deed. Those constraints are there for a reason, is to make sure that's not considered a sham for the purposes of the tax review. But those constraints will obviously have to be applied as the business goes forward. And like I said, you need to also be very conscious on your employee messaging, because there may be some time before the employees see actually the distributions of the company's profits. And our experience, some employees have been knocking on the door on day 2 asking to see the next financial return because they want to see when they're going to get all the profits from the business. As we've discussed, those payments will obviously be going to the sellers in the first instance, and maybe even to bank funding. So it may be some time before the employees see the true benefits of being a beneficiary under the trust. They will, of course, have the benefit of the income tax relief bonuses, though, during that time. It is, like I said, a technical process with many inverted pitfalls, which could preclude the tax relief. And like I said, it is something that you really do need to speak to an advisor who has been through the process before, from the tax side, from the valuation side, from even the accounting side, as well as the legals, just because it does require a fair amount of review and scrutiny before submission. And John, I think that's probably your time to sort of discuss specifically those tax advantages as you would see them for the EOT.
That's great. Thank you, James. Morning, everyone. As James has said, I'm Jon Stevens. I lead the tax and private capital practice at DWF. And my team and me, we've been heavily involved in a number of employee ownership trust transactions. We would typically advise on the tax conditions, which I'm going to talk about in a moment, and how you obtain the tax reliefs. We would also be involved in reviewing the documents to make sure they're right, which is critical. You need a bespoke set of documents for an employee ownership trust transaction, including the trust deed and related documents that we also get involved in drafting. Now, as James has mentioned, EOTs have been around for some time. These originally came out of the coalition government and a brainchild of Vince Cable, if you can remember him. The legislation, as James said, was published in 2014, but we really saw a very slow take-up in EOTs throughout the UK, and there were probably only a few hundred done by about 2020. What we have seen across our business and across the market is really that it's accelerated since 2020. The number probably doubled in the first 2 years, 2020 to 2022, and it's probably doubled again since then and continues to accelerate. And I will talk about some of the context for why that might be in a little bit. Now, although this slide is headed tax advantages, I just want to emphasize one of the other points that James has made, and that this isn't a tax wheeze. No one should be contemplating this purely for the tax benefits. If they do, I think that will be a mistake. And I can talk about some of the reasons for that later. The real reason to do this is that it's an alternative form of business succession. It is the long-term future of the business, where moving to employee ownership will benefit that business through having a more engaged workforce who will be able to drive and grow the business. And the seller should be interested in that as well, because not only are they leaving their legacy to their employees, but they're also going to be very interested that the business prospers so that they can get the deferred consideration that they've sold their shares for, and there's no risk of any tax reliefs being withdrawn. So having given that warning, what are the tax advantages, the key tax advantages of selling to an EOT? Well, the one that most people focus on is the capital gains tax relief. So that an individual seller selling shares to an EOT does not pay any capital gains tax in the UK on that sale, provided various conditions are met. And the first thing I want to say is that it isn't really an exemption as such. What it is a deferral of tax. And that is because the trustees of the EOT inherit the seller's base cost. So ultimately that tax will be paid. It just won't be paid by the sellers. It will potentially in the future, if the business is sold by the trust, be paid by the trustees. And why would the trustees accept that? And why would the employees who are the beneficiaries of the trust accept that? Well, because they are now going to grow the value of the business, and all of the future upside and growth and value will belong to them. So that's the reason for doing that. The other important thing to flag that I'll come on to is that there is the potential for a clawback, and recent changes that came into force from the 30th of October have extended the time limit for that clawback. So that's something that everybody needs to be very aware of. So that's the first tax advantage, the capital gains tax relief. The next tax advantage is for the employee group, and that is that they can be paid a bonus of up to £3,600 per employee per year, income tax free. As James mentioned, rather oddly, it isn't free from national insurance contributions, but it is free from income tax. And the key thing to note is that the bonuses, and they have to be bonuses, this can't form part of the ordinary salary or remuneration, the bonuses must be paid to all employees, and all employees must be treated equally in the payment of bonuses. Now, that doesn't mean that everybody has to be paid exactly the same. In determining how the bonuses are quantified, you can take into account individual employees' remuneration, individual employees' length of service, and the number of hours that individual employees work. You can have to consider those factors individually in determining the bonuses. You can't lump it all together. But all employees must benefit, and you must look at those criteria. Now, interestingly, that includes non-UK employees. So non-UK employees have to be treated equally in order for the reliefs to be available, both the CGT relief and the income tax relief, but the tax exemption only applies to UK employees. So if you had employees in the Republic of Ireland, there's a requirement that they're paid bonuses, but it wouldn't be tax-free for them, I don't believe. And one of the changes that came into force from October is that now directors can be excluded from the payment of bonuses. So previously, where all employees and office holders had to be treated the same, now we can discriminate against, but not in favour of, directors of the company. And the final point there is the payment of the bonuses are treated by the company not as a distribution, but effectively as the payment of a bonus. It's for the benefit of the company's trade, and so the company will get corporation tax relief on those bonuses. So having talked about the tax benefits, what are the conditions for tax relief? And it's true to say there are lots of conditions. The conditions are quite complex and they differ slightly for the CGT relief and the income tax relief. So there's a number of things to watch for. Now, I will run through these conditions and pick up some of the key points that you need to be aware of if you're thinking about an employee ownership trust as a potential route for business succession. These really need to be looked at in detail, subject to the business and the overall transaction, because the legislation, as I say, is complex. And usually the documents should reflect these conditions and ensure that the conditions will be satisfied. So when we draft the trust documents, we ensure that these requirements will be met and the trustees have an obligation to meet these requirements. So the first requirement is that the company must be a trading company. It can't carry on investment business. It has to be actually carrying on a trade. And what does that mean? Well, the company or the trading group must be carrying on trading activities, and that means that it must not include, to a substantial extent, non-trading activities. What on earth does that mean? Well, the revenues say that substantial means 20% or more. And when looking at whether something is substantial, one looks at the turnover of the business. So it is more than 20% of the turnover coming from non-trading activities, from investment activities. One also looks at the asset base of the company and how its capital is employed. And one also looks at the time spent by the employees and the officers of the company. Are they spending more than 20% of their time on non-trading activities? That's what the revenues say one has to look at when determining whether or not the non-trading activities are substantial. Although recent case law seems to take a more holistic view of companies and look at the whole picture, rather than whether or not a company fails a particular test. Now, most of the companies we see and talk to about EOTs clearly meet the trading requirement, but it's something that you definitely have to have an eye to and consider, particularly when looking at the asset base of the company. The next condition I've already talked about, really, which is the all-employee benefit requirement. The trust has to be set out and drafted in careful terms to make sure that the trust benefits all of the employees of the company and its group. And that is very important. As I say, this is about broad employee ownership. And I'll talk about that some more in a moment. Next is the controlling interest requirement. So this means that the trust must acquire the company and it must have a controlling interest, which means more than 50% of the company's ordinary share capital. And if there are various classes of share capital, determining what is an ordinary share or not can be tricky. The trust must contain more than 50% of the voting rights. It must be entitled to more than 50% of the profits on a more 50% of the profits as they're distributed, and more than 50% of the assets on a winding up. And there cannot be any arrangements in place to reduce the trustee's entitlement without the trustee's consent. So you can't set this up to be met for a period of time with arrangements whereby it won't be met afterwards. As James has said, in the majority of the businesses we have worked with on EOTs, we think we have seen total sales, 100% sales of the shares into the trusts. Some of them perhaps partial sales, but they always has to be more than 50%. And that will really vary depending on the value of the business. The next condition, the limited participation requirement, is potentially quite complicated. And I won't go into too much detail other than to say what this is designed to do is to make sure that the businesses that are able to obtain EOT relief are ones that have a broad number of employees. When one looks at the limited participation requirement, you look at the number of 5% shareholders and the people who are connected with them. So these are considered people who are participators in the business. They have quite a say over the business. And that number of people who have 5% more shareholding or they're connected people cannot be more than 2/5 of the entire employee base. So you couldn't have a business with a very small number of employees or with perhaps a large number of shareholders reflective of the number of employees. That won't work from an EOT. That's not what this is designed to do. This is about broadening employee ownership. The next condition for relief, for the CGT relief, is that no related disposals. So this is effectively a one-time relief for shareholders. There can't have been any earlier EOT claims for the same company or group. And in the pink box there, what we've got is we've got some new conditions that were introduced on the 30th of October 2024. The first one is that the trustees must be resident in the UK, and I'll come on to talk about that in a moment. The trustee must also be independent, and this is quite important. Now, as James has mentioned, what typically happens is that the company shares are sold to the trust. There will be an upfront payment to the sellers, but it's likely that some or a large part of the consideration will be left outstanding and will be paid from the future profits of the business. So the sellers have a real interest in remaining involved in the business and ensuring that it's run well and ensuring that they get their deferred consideration. So it is normal for sellers to stay on and perhaps a key seller to be a trustee of the employee ownership trust to protect their position and protect their deferred consideration. But because the purpose of this legislation is actually to pass the business on to employees and for the EOT to control the company, therefore it would be strange if the seller or sellers were able to control the trust. And so this change was introduced from the 30th of October 2024 so that the trustees have to overall be independent. Now, the sellers could stay on. A key seller can be a trustee of the EOT to make sure their interests are protected, but the majority of the trustees must be independent and separate from the seller group, these 5% sellers. So they will typically be independent trustees and employee trustees, and getting the balance of the trust members and getting the balance of the trust constitution right is really important in making sure both that you qualify for the tax relief, but also that the business is going to be well run and for the benefit of everybody involved going forward. And you will have people with completing interests. They may be sellers, trustees, and employees, and we need to balance all of that. And there was one further point, which was around the market value, which James had mentioned. Now there is a clear requirement that the trustees cannot acquire the shares for more than market value. If that happens, the relief won't be available. That's now a legislative requirement, but it was always implicit because it had previously it would have been a breach of trust had they paid more than market value. There are also some anti-avoidance tax rules related to something else that would ensure that market value was paid. And also if a bank is financing any part of the consideration, they will want to make sure that not more than market value is paid for the shares. So more on trustee residency. As I mentioned a few moments ago, this is a new requirement that was added from the 30th of October 2024, that the trust must be tax resident in the UK. And why is that? Well, it's because this is intended to be a tax deferral rather than a tax exemption. And if the sellers sold their shares to the trust and did not trigger a capital gain because they qualified for the EOT relief, the idea is that that tax will ultimately be payable by the trust when it disposes of the business. But if the trust was offshore, then that tax wouldn't be paid because an offshore trust would not typically be within the charge to UK tax. So this was actually a neat way of completely avoiding tax that wasn't intended originally. And so the legislation has now been put in place to make sure that the trust must be UK resident and subject to UK tax. Now, that doesn't mean that you have to have all of your trustees UK resident. You can have non-UK resident trustees, but the real decision-making behind the trust must be onshore and the trust itself must be onshore. Now, I mentioned clawback earlier, and it's quite important to be aware that if a disqualifying event takes place, then the sellers either won't be eligible for relief in the first place if it takes place very shortly after the sale, or if a disqualifying event happens after the sale, the seller's relief can be clawed back by the revenue. And that's a situation clearly nobody wants. Now, originally, the clawback would take place if a disqualifying event occurred in the first tax year following the tax year in which the disposal took place. So could be effectively 2 full years, depending on where your transaction took place within the tax year. If you carried out your transaction on the 6th of April in 1 year, you'd be looking at almost 2 full years. That clawback period has actually been extended by the changes that were introduced on the 30th of October, so that it now applies for the first 4 tax years following the tax year in which the sale takes place. And typically what would happen in the sale documents is that the sellers will seek an indemnity from the trust, so that if a disqualifying event happens, they can seek the tax from the trustees. And is that fair? Well, potentially, because it should be the trustees who are taking on this tax burden. As I've said, this is a deferral rather than a relief. And if a disqualifying event happens after the 4 tax year period, then there's effectively a clawback on the trustees in any case, because this is for the continuing long-term benefit of the business. So the idea is that a disqualifying event won't happen. So you'll ask me, John, what is a disqualifying event? Well, they're listed in the box there. That's the company ceasing to be a trading company, the trust ceasing to be for the benefit of all employees, the trust ceasing to control the company, or the trustees no longer being independent or UK tax resident. So as you can see, as I say, this for the long-term ownership and benefit of a trading business.
Thanks very much, John. Obviously, as you said, quite a lot of information for you to take on board, but ultimately a lot of this then comes into how you actually set it up. Now you've decided that you think you'll be qualifying for it, and it's a number of different aspects which I've sort of listed out in this slide. The key and critical one is the valuation report, and that's an independent valuation of the company, and that determines the fair market value of the shares being transferred to the EOT. Now, John's obviously explained that if you get that valuation overcooked, there are implications for the HMRC, and in reality, most sellers will err on the side of caution. On the larger deals we've done, we've seen the sellers obtain a valuation report and the independent trustee obtain a separate valuation report. That obviously depends on the size of the business that's going into the EOT. But we have seen 2 in the past, just to show to HMRC that we have independently reviewed the valuation. But more often than not, you'll just deal with one. And if that valuation comes to a conclusion that the sellers are happy with, you then move on to the legal documents, and that's where essentially I have to get busy. And the first aspect is the trust deed, which is between the company and the trustee company we set up to set up the trust. And then we have the share purchase agreement, which is the terms which the trustee company, as the trustee of the trust, is acquiring the company's shares in the sellers. That share purchase agreement will look a little different to the normal type. It may not contain certainly as many warranties, though if you are obtaining bank funding, some bank lawyers will insist that they do see warranties between the trustee company and the company that is giving them. They also may wish to see a tax covenant at times, and they also will want to see a disclosure letter against those warranties. They will invariably not need to ask for any diligence. We haven't seen any requests for that to date. They'll look at the financial diligence. They may look at other aspects as well as the valuation report, but most bank funders won't actually ask for legal diligence against the company as well. The key thing to be also mindful of is your corporate governance documents. You'll be having an entirely new shareholders agreement potentially, and articles of association if you have a mix between the trust and existing shareholders. But you will always have to change your articles for both your trading company and your articles of association for your trustee company to essentially create the governance regime that you need to put in place to show the independence of the trustee company from the company. One key thing I'd want to point out to any accountants out there, and accountants are the ones who I would always lean on in this, is to make sure that the trustee company and your trading company are not consolidated for the purposes of the accounts. That is a critical thing, and the answer to that can usually be found in bespoke drafted articles to make sure that that is very clear that they are not going to be consolidated. Your HMRC clearance, I call it statutory and non-statutory. The statutory clearance is quite a specific clearance, and your non-statutory clearance was a more general sort of statement about what you were trying to do. You would send that into HMRC, and in the past, you would get a relatively, hopefully, clean bill of health for what you were trying to do. Since about the 30th of October, we've seen on the non-statutory clearance side, HMRC literally writing back to us and saying, look at the rules. And I think that's because, in their view, in my opinion, they are maybe a little bit concerned about giving advices whilst the changes are still ongoing with the finance bill. And we'll talk about those changes shortly. And now I'll pass over to the funding side to my colleague Scott Kennedy, who can sort of list what would happen in terms of financing these acquisitions.
Good morning, everybody. I'm Scott Kennedy. I work with James in our Belfast office as part of the corporate team, and as part of the funding package for an EOT transaction, I suppose there's a number of there are a number of pots which need to be filled by the funding. There's obviously there's the initial purchase price, and then there is the deferred consideration down the line, but also there's the company still has a need for general working capital and growth capital if hopefully it's seeking to expand and invest in things to do so. So as has been mentioned a few times earlier on, the structures that we see are, there's obviously there's a certain amount of cash in the business which can be applied to meet the initial funding costs. So that's your that would be your upfront purchase price, but also there are transactional costs in there, and we flagged a few of those at the left hand side of the slide. So clearly, there's going to be advisor costs in there. So you've got your valuation costs, accountants, fees, corporate finance and tax, your trustee appointments, and then of course legal costs too. So the sources of finance to fund all of these are usually a mixture of senior debt, which is your standard sort of bank term loans and overdraft facilities and things like that. You've then got potentially a variety of mezzanine or alternative finance products that might be available depending on the type of business that you have. So, maybe working capital funding or asset finance products in there. And then finally, of course, you've got the deferred consideration, which is usually in the form of vendor loan notes. And those funders all sort of those sources of finance all interact, like as would be the case with any bank debt. They will look to take priority of payment in terms of the cash flows of the business and also in terms of their security position. Any other debt funders will look to do the same thing, and then the vendor loan notes are usually at the bottom of the stack in terms of priority. There may or may not be a full subordination of those vendor loan notes, depending just on the funder's attitude and how strong they think the general banking and lending covenants are that they're receiving from the company itself. So, we have seen subordinations which are only in favour of the mezzanine funders, but there can quite often be the case where the vendor loan notes are subordinated to all of the external funders. So you are having to go out and seek consent to those vendor loan notes being repaid down the line. Thanks, James.
Thanks very much, Scott. So I'll just go very quickly then on to essentially what we think in terms of the tax regime going forward. One thing before I touch on that, I would want to say that there are also other ways to raise sort of incentivize employees through growth share plans, which we've done in businesses since the EOT. So to incentivize management, there are other share option schemes that you can put into place, subject to changing the articles and making sure that you have the correct regulations in place for that. But they are all possible to incentivize management and have been used in transactions we've worked on. But the tax landscape, as we all know, is changing constantly. It may have changed in the last 45 minutes, but John will tell me what it was at 10:59 in any event.
Well, I think we're promised no further tax changes today, but let's see.
John, no, let's not get too ahead of ourselves.
So one of the reasons for the increase in the take-up of EOTs has been the broader changing landscape. You will all be aware that from the 30th of October, the higher rate of capital gains tax increased to 24%. And what we're also seeing is an erosion of business asset disposal relief, what used to be called entrepreneurs relief. It's currently still 10% on the first £1 million of qualifying gains. That is increasing to 14% tax rate from the 6th of April this year, and will increase again to 18% from the 6th of April next year. And so business asset disposal relief, while valuable and definitely worth having, its value is being eroded. And that, along with the increase in the CGT rate, is definitely a reason that sellers see EOTs as being more attractive. So we touched upon some of the changes in Finance Act 2025 that have already come in from the 30th of October. I've covered the first 3 bullet points. The 4th bullet point is really a technical change. James talked about the non-statutory clearance. Typically, that would seek to determine that the trust would not be taxed on contributions from the company to satisfy the deferred consideration and its other costs, and that is now set out in legislation. It was a gap in the original legislation when it was introduced, so they have corrected that. And on the next slide, again, we've covered most of the bullet points there, apart from perhaps the 3rd bullet point, which to me, as a boring tax geek, is possibly the most interesting, which is people who carry out EOT transactions are now required to provide more information to the revenue about the transaction. And it's clear to me that the government will be monitoring the use of EOT transactions, seeing what sort of businesses are adopting EOT structures, whether it's actually serving the purpose that they wanted it for. So that is why there is the additional information gathering requirement. I don't make predictions about tax, and had you asked me before the 30th of October what would happen in the budget, I might have said I'd be surprised to see EOTs remain, because the tax relief is pretty generous. So the fact that the revenue are going to be monitoring the use of them is something that I think is really interesting.
And I can assure you that John made no predictions, because I asked him on a daily basis throughout the months of August, September, and October what would happen to the tax regime. And more often than not, he wasn't too far off. But yes, predicting the tax regime right now is quite a challenging task. These are the final sort of areas I would say to anyone to look out for in an employee ownership trust. The benefits are there. Hopefully you can see the increased the continuity, the stability, the tax advantages that come with it. It may not be appropriate for your business, but you may find after a feasibility study that you find it is an appropriate way through. I know from speaking to Stephen that he is surprised how people are welcome to it, and he's quite pleasantly surprised by that. And I think the people from Employee Ownership Ireland will be speaking to the manufacturing group in the next few months or so to discuss how they see employee ownership working in Northern Ireland going forward, because I think the sectors that are involved may actually have some good alignment, and it may be something that we'll see more of in the next coming years. The key things to look out for is always the same. The valuation is very important. You have to show as the trustees that the price is the right price in terms of it keeping the tax benefit alive. There is some increased administration now because of the key changes. As John has said, trustees are now required to claim statutory relief. Your trustee really should have an independent trustee who knows what they're doing at this point. It shouldn't just be people who have just, first of all, started before. There is an education process in your trustees, and there are professional trustee companies out there who are willing to offer their services to assist in this. Your trustee costs, we're still waiting guidance as to whether those trustee costs can be excluded from tax. And then ultimately, we just need to be clear on the clawback provisions. The jump from 1 year to 4 years is something that I think we weren't necessarily expecting to see, and hopefully that's where it stays. But obviously you need to be conscious of the timing of your deal. As John said, doing your deal on the 6th of April would actually mean it's in practical terms 5 years by the time the following tax year comes around. So your timing of your deal will also be important if you are considering the issues around clawback. And that's essentially all for today from ourselves. Very happy to take any questions from the room that anyone has. Thanks very much for your time.
James, Scott, and John, thanks for that. It was very comprehensive in a good way, not in a bad way.
I know what you mean. I know what you mean.
I mean, you did set the scene early on and said that this is a very technical area involving trust law, corporate law, tax law. So to get through that inside 50 minutes and keep it focused on the things that people really should be interested in, I think was a great job in itself. But we do have some questions that have come in the chat, and I've had some directly from people who don't want their to be identifiable, obviously. I'm going to start with a couple of really quick ones from myself. In terms, I mean, this is a route. I think it was yourself, James, talked about this is a simpler route than perhaps maybe a straight up sale to a third party, for instance. But I'm assuming that all the other, or lots of the elements of selling to a third party around due diligence, etc., that type of activity still is required in order to give confidence to the trust, who will eventually be the owner, that they're buying something that is been behaving legally, and the numbers that they're being presented are the correct numbers, etc.
Yes, also the financial diligence is still critical in terms of the valuation. And like I always say to anybody before they are undertaking EOT is, tell me that you back your FD. Now, the answer to that may not always be the answer I want to hear, but ultimately that's he or she's a critical element to that aspect. That your FD can produce comprehensive information. From a legal side, Stephen, as I said in the talk, it's not actually as detailed as it would be on a third-party deal. And the one thing I would say is that you do at least write a timeline on an EOT. It's dense and it requires advisors to be sort of holding your hand throughout, but you don't have the same, how I would describe it, variations with third parties and potentially issues that come with them and aspects outside your control. Ultimately, the sellers and the business should be in control of the process, and realistically, it's just the position behind getting the clearances from HMRC that are the critical parts.
And John, you mentioned that bonuses need to be treated equally across all employees.
Yes.
Obviously, there's lots of businesses use bonuses as an incentive to encourage performance, etc., etc., etc. I'm assuming none of that is excluded.
No. So what we're talking about is this particular tax-free bonus. So the up to 3,600 per employee that can be tax-free. And as I said, there are criteria that companies can use to distinguish between employees. So between part-time workers and full-time workers, people who have been there for less than a year or for a very long time, they can distinguish between employees on that basis. But of course, once we've paid out the maximum tax-free bonus, the business is still free to pay other bonuses to employees.
Thanks. I think it was an important piece of clarity there just for people. A couple of quick questions. We have about 4 minutes left in total. Can you explain how a typical employee ownership trust is managed and how the main decision makers are incentivized?
Well, I suppose from decision makers being incentivized, it depends on who your parties are. For your independent trustee, obviously they have an independent trustee contract with the company, and they are paid for that service to be an independent trustee. From your employee trustee relationship, their incentivization is to make sure that the business is making the correct decisions to avail of profits for all the employees in the business, which hopefully will all be coming once the payments through either the bank funding or the seller outstanding payments have been made. And for the seller director, the incentivization is pretty clear. They need the business to continue going on to get the payments that they are due under the terms of the share purchase agreement. So hopefully that answers that question.
It does. Question here from Aidan O'Neill from the Employee Ownership Ireland organisation, which you talked about, James.
This will be hard. Oh no.
Earlier. It's not actually. It's a really good one. Are banks or other financial institutions in the UK willing to look at financing or partially financing transitions to EOTs?
They are.
And why do you think Northern Ireland has been slower in developing EOE businesses? You mentioned at the start that this is an increasingly interesting area for businesses in Northern, but we do lag behind the rest of the UK. So are banks willing to fund the transition? And why do you think that businesses locally are a bit slower in the uptake?
Banks are very willing to fund. I advised banks before. It is an educative piece, and that's where Aidan comes into it, and I'll put it back to him. He should be the man that will be driving that for the next 12 months or so. But ultimately, we have, for example, banked in Savage and Witten through their incumbent lender, and there was no issues at all with them taking on. They had known the business for a long time, so they didn't require any additional diligence. In the transaction that we're doing right now, which will be the largest value transaction by at least 100 million in the transaction that we're doing, that transaction has been bank funded. And again, the bank's lawyers have been particularly pragmatic, and the bank is being pragmatic in that. So banks will have an ability to fund this if they understand the business already, and that will be part of their normal diligence. It may take a couple of extra meetings to clarify it, but ultimately the structures and the security structures should all be relatively familiar for them. In terms of the delay as to why it's only picking up in Northern Ireland now, ultimately, I think that just comes back to seeing examples. Savage and Witten, Relinia, other examples. There's only maybe, say, 10 or 12 that have moved on, but there are 10, 12 more than we had 2 years ago. So I think you'll see a lot more coming through as people see how it works in practice, and their stories become more success stories, hopefully, as they go on. And to date, I don't see any sign of that. I see more sign of these things increasing rather than decreasing, quite frankly, particularly given the current changes to the tax regime.
And finally, just a question. So you very helpfully put on one of the slides that this was in order, the good reason to do this was to maintain corporate culture within an organization. And there's a question here about one of the biggest challenges for SMEs in particular in Northern Ireland is attracting and retaining people. Are there examples in the UK that you've seen that employee ownership businesses are finding it easier to attract and retain people? So not just about retaining that culture, but actually being an attractive potential employer.
From my understanding of the most recent study, they couldn't quite pin as to whether it was actually attracting staff, but in my view, I can't see how it can do any harm if it's I think people's reasons for moving maybe wide and varied, but certainly the reasons for staying is obviously the key critical thing for any business. Once you lose staff, they are incredibly hard to replace, and staff retention, I think, in the next 2 or 3 years is going to be one of the key aspects for any business's success going forward. And this is one tool that you can use that I think has shown to allow for staff retention.
I agree. Sorry, go ahead, John.
Sorry, Stephen. I was going to say I worked with a business a few years ago in the transition to EOT, and it was definitely a factor in terms of retaining staff since then. Is that, you know, there are employees who are on the trustee board, they benefit from tax-free bonuses, but more importantly, they have their eyes on the benefit and the growth of the business that they will all see in the future.
And I would say to those people who are in key management roles who feel that somehow they have been removed from a potential management buyout, there is obviously processes with growth shares that you can put in to keep them incentivized to continue the business success, which is critical to how the EOT performs.
Absolutely. The employee ownership will want the business to be successful. The seller would want the business to be successful. So it's everybody's interest. But they also have a stake in the game to ensure that happens. We sadly run out of time, and we need to bring the session to a close. Can I just say a couple of things quickly? One is just to repeat, we are sharing the presentations and the recording after the event. We aren't here to offer free legal advice, and I think you've been very good at actually providing lots of answers to questions that people have in the more general term. But every business will have its own individual circumstances, so it's really important, and you referenced that right at the start, that they do get the proper technical advice, probably beginning with that legal advice through DWF, obviously. So people should contact James, John, or Scott, or even if they get in touch with us, we'll be happy to provide the introductions going forward. And finally, just to say thank you to you all for participating. Thanks also for the questions, both anonymous and visual there, and thanks for providing us with some real clarity in a really interesting area that I think is grabbing more and more attention. Thanks very much, everyone.
Thank you.